To our college savings web. All right, the recording message just came on. Welcome to our college savings webinar. September is college savings month, and we're excited to be doing our part to help families start saving and meet their goals. I'm Martha Kordiak-Mert, COO of Saving for College, and I'll be serving as the moderator today. For those in attendance, we welcome your participation. You can type your questions into the Q&A section of the screen, and we'll try to address as many of those as possible as we go along. In addition, you can check the chat box throughout the webinar. We'll be adding links to relevant information and tools to help you continue your research in that box. After the webinar, we will be sending out an email with a link to the recording of this webinar. So if you've missed part of it or you just want to watch it in a slower time, you'll have a chance to do that. We'll also include a feedback survey there, and we would love to get your feedback afterwards. So today's webinar is being brought to you by College Choice CD 529 Savings Plan. Okay, I'm sorry guys, I'm having a little technical issue here. Okay, I'm trying to change slides here. Let me try that again. There we go. All right, today's webinar is being brought to you by College Choice CD 529 Savings Plan, which provides multiple FDIC insured CD investment options and a high yield savings account without charging any fees. Learn more at www.collegechoicecd.com. College Choice CD is sponsored by the state of Indiana and administered by the Indiana Education Savings Authority, which is generously offering to attendees a chance to win $500 toward an existing or new College Choice CD 529 plan account. Saving for College will randomly select 2 names from among the webinar registrants, and we'll announce the winners at the end of today's webinar. We'll follow up with you separately after that as well. So let me introduce our panel. To help answer your questions today, I'm joined by 2 highly knowledgeable panelists. The first is Marissa Rowe. She's Executive Director of the Indiana Education Savings Authority. Marissa oversees Indiana's College Choice 529 Direct, Advisor, and CD savings plans. These plans represent over $6 billion in assets under management in more than 400,000 accounts. Welcome, Marissa.
Hi, happy College Savings Month.
Yes, and next I'd like to introduce Patricia Roberts. Patricia has spent 23 years in the college savings arena, most recently as COO at Gift College. She is also the author of the book Route 529, A Parent's Guide to Saving for College and Career Training with 529 Plans, in which she shares both her professional expertise and personal journey as a mom saving for her son's education. Patricia has generously offered to donate a copy of her book to 5 lucky webinar attendees. Saving for College will randomly select the winners of the books, and we'll follow up with them after the webinar. Patricia, welcome to the webinar.
Thank you so much, and glad to be here with you today and with Marissa.
Wonderful. All right, so ladies, before we get started, I thought it would be great to ask the audience to respond to a poll question. It's one we like to start with to get a sense of who's in our audience. So we will be asking the respondents to answer this question. Have you started saving with a 529 plan? Mark, can you launch that poll question for us? That's up there already, great. So people can go ahead and put their responses into that poll, and once that slows down, he's gonna share the tallies with us. And it's a great way to, I think we'll typically find in our audience that we have people who are already saving and some who haven't started. All right, the results are up. Wow, we have a lot of people have started saving with a 529 plan. So to them, I say congratulations. 32% have answered no. So hopefully we'll be able to provide some information to help them get started. All right. I notice that Marissa and Patricia are muted. I don't know if that happens automatically. So there we go. All right, wonderful. Okay, so let's go ahead and get started, knowing that we have a lot of people who already have 529 plans. I hope we can provide some insights to them that are going to help them to get more out of them. But we're going to start with some of the basics on 529 plans for the folks who haven't started yet. So let me go to sorry, I'm having some technical difficulties with our slides today. I apologize. I want to share with the audience the topics that we're going to be looking at. There we go. All right. So today's topics, we have a pretty ambitious agenda. We've got 6 topics outlined, and we're going to be asking a number of questions as we go through this. We've got some prearranged questions, but we'll also be looking at the Q&A box and adding some of your live questions as we go along. So we aim to cover ways to save for college, types of 529 plans, savings and investment options within 529 plans, setting savings goals, 529 plans and financial aid, and grandparents and 529 plans. So we'll do our best to get through as much of this agenda as we can today. So starting with ways to save for college. Marissa, can you tell us what is a 529 plan and how do they work?
Absolutely. So a 529, they're an incredibly powerful tool to help families save for future education. Accounts are funded with after-tax dollars. They grow tax deferred, and then distributions are tax-free when used for qualified education expenses. So the idea is it's an investment account that allows you to start saving early and often so that you can reduce the need for student loans later on.
Okay. And Patricia, something that comes up often is people say, well, so why should I use a 529 plan? So what are other savings and investment vehicles that people sometimes do use for education savings?
Sure. So first of all, there's definitely more than one way to save for higher education expenses. And the good news is that most of those approaches are not mutually exclusive, meaning you can pursue a number of different paths. In terms of other ways to save for higher education expenses that families tend to pursue outside of 529 plans, there are Coverdell education savings accounts. Mm-hmm. There are Roth IRAs. There are uniform gift and uniform transfer to Minors Act accounts. Those are sometimes called UGMA and UTMA accounts. Parents may be familiar with those. There are certainly mutual funds and other forms of taxable investments. And then others sometimes pursue annuities or life insurance products for this purpose.
Okay, thanks. That's such a great overview. So let's talk just a little bit about how 529 plans compare to some of those vehicles, because there are some unique advantages that 529 plans have. So, you know, it may be that for a particular family, some combination of vehicles may be right. But there are some things they should probably be aware of in terms of how 529 plans compare. So let's start, you started with Coverdell ESAs, I think, Patricia. So can you talk a little bit about, I know Coverdell ESAs, for example, can only be used for certain expenses and have limitations. Can you talk just a little bit about that?
Sure, I can. I mean, the things I tend to talk about just broadly in terms of comparing the types of investment vehicles are control, whether there's income limits, whether there's annual contribution amounts that vary, the financial aid treatment, the ease with which others can contribute, and the ability of the account owner to pull those funds back should they need them. But if I can talk from that perspective, I'll definitely bring Coverdell into the conversation. Is it okay if I go with those broad categories?
That sounds great.
That might be helpful for people. Okay, in terms of control, I think this is one of the most important features of 529 plans, because with 529 plans, the account owner, often the parent or grandparent, could be someone else, but that person who's named account owner remains in complete control of the account over the course of its lifetime. So that is very different, for instance, than a custodial account. An UGMA-UTMA account is one in which the control switches to the beneficiary at the age of termination. Now that's typically age 18 or age 21. So whereby with 529 accounts, it's that account owner who decides whether, when, and under what circumstances to disperse funds. In an UGMA-UTMA, the control is lost as soon as that child reaches that maturation. In terms of income limits, there are no income limits on 529 college savings plans, unlike Coverdell, Martha, which you mentioned. There are limitations. I believe it's currently adjusted gross income of $110,000 or $220,000 for those filing a joint return, but you can't invest in a Coverdell if you're making more than that. 529 gives no consideration to those income limits. Also, I look and see whether there are annual contribution limits that people need to have in mind. For 529 plans, there's $15,000 a year annually that can be contributed to an account per person. And 529 has a special provision where 5 times that amount, or $75,000 per taxpayer, pursuant to these accelerated gifting rules under 529 can be contributed. So we've got a high amount that can be contributed annually for 529 accounts, and even higher if you pursue that accelerated gifting. But with a Roth, it's a lower amount. It's $6,000 annually or $7,000, depending on the age of the contributor. And with Coverdell, in contrast, I believe it's $2,000 that can be contributed. So a big difference there. The other thing I look at is time limits for 529 accounts. Is there a certain amount of time that these accounts can be kept open? The answer is no, they can be kept open indefinitely. So unlike Coverdell accounts, for instance, which need to be used by age 30, that is not the case with 529. Coverdell can stay open longer if the child has, or the beneficiary has special needs, but typically it's age 30. And then I'll move on to financial aid considerations. With 529, there's a very minimal impact for federal financial aid purposes. With UGMA-UPMA, it's more significant. And the last 2 points I'll make is I always look at the ease with which others can contribute to these accounts. 529 makes it extremely easy. It is more complicated when accounts are held in other vehicles to get money into accounts. And then lastly, what's the ability of that account owner to switch the beneficiary or pull back the funds? For 529, there's a lot of flexibility. Some of these other accounts, particularly irrevocable ones or trust accounts, the account owner cannot do that. Once that money's in there, it's earmarked for that child. Now, I know that's a long answer, but lots of ways to save, but always do your analysis with respect to these different factors.
That is a fantastic summary, Patricia. And one other thing I'm just going to mention, because Jimmy had asked a question about, is there a limit on how much money I can save in a child's 529 plan? So I think another thing that makes 529s very flexible is that they have tend to have very low minimums. In some cases, you can open an account as little as $25. And very high maximums. I don't know. I see Marissa nodding. I don't know, Marissa, if you want to.
I would love to jump on that, because in Indiana, the minimum is actually $10. And so when you have multiple children, I mean, $10 is much easier to come by than, some of those larger amounts. So just getting started. And then as far as contribution limits, that's going to vary by state. But I can tell you $400,000, $500,000 is not unheard of as limits. And what you think about is, what is the full cost of education? Now, for folks, we have a lot of folks on this call who have not started saving yet. I'm not coming at you with a $500,000 number. We're talking about maximum, right? So what can you save? How much can you have in your account? You can go for that larger number and have that goal set for your family, whatever that is, right? I'm an aunt saving for my nieces. So when I think about, well, what will books cost? You can set goals like that. But as far as minimums and maximums are concerned, it's going to vary by state, but some of them it's $0 to $10 to get started. And you can have several $100,000 depending on the states that you live in, which is generally what they think that a 4-year education will cost in that state.
All right. And Marissa, sticking with you for a minute, can you also, one of the things we didn't really talk about is that in some states, there are additional benefits for residents. Some of them are tax benefits and other benefits. So can you speak to that a little bit?
Absolutely. So the thing to remember is that the fact that the dollars go in after tax, and they grow tax deferred, and then distributions are tax free when used for eligible expenses. That's the same across the board. So no matter what 529 plan you choose, that's kind of the basis that we all start from. But then what you find is that individual states offer their own perks and benefits for contributing to that the plan for those states. So you're going to see some states will have tax credits. In Indiana, it's 20% worth up to $1,000 a year. You're going to see tax deductions. You're also going to see special treatment. So in some states, your 529 assets do not count against you for things like state scholarships or other programs by the state. So again, that's going to kind of vary. What's really cool about some of those state benefits is that it's not just something that the account owner can take advantage of. So you're going to have third-party contributors who can also contribute. So again, aunt saving for her nieces, you can get those benefits even if you're not the account owner. So it makes it a super powerful tool. You know, it takes a village to send a kid to school. And when we say college, we're also saying, you know, anything post high school, right? Because that's really changed a lot. But when you can kind of get that village there and crowdsource those funds, it becomes a super impactful way to save for kids.
That's great. Marissa, Patricia, anything to add to that?
I think Marissa hit it a home run there with all that information. I think, you know, she's exactly right. And some states do offer these special benefits. They're definitely worth checking into.
All right. And let's see, this kind of leads naturally, talked about a couple of things there, Marissa, in terms of that 529 plans can be used for or higher education, anything post high school. Can you talk a little bit about what can 529 plan proceeds be used for, 529 plan earnings be used for, that within the rules, so that you're not subject to federal taxes? So in other words, what counts as qualified expenses for 529?
Sure. And so for those who are interested, when you're getting your search engine out and you're typing in qualified expenses, that's actually grown over the last few years. So traditionally, it's always been tuition and fees, some room and board, because you do have to be enrolled half time, laptops. Now it's registered apprenticeships, right? So we're looking at education shifting and changing. And so you now have this longer list. And the thing to keep in mind is these qualified expenses, it's all based on the fact that you're enrolled in an eligible institution. So then we dig into what's an eligible institution. When you unpack that, it's any school in the US or abroad that accepts federal financial aid. So that's 2-year, 4-year, public, private, tech, trade, PhD, graduate school. You can actually find that list, the US Department of Education. They have that list. Saving for College, that website, you guys also have a list there. But really what you're looking for is there's a good laundry list of qualified expenses, and you want to make sure that you're attending an institution or a registered apprenticeship to be able to use your funds without any negative consequences. It's a really pretty broad list.
Yeah, and like you said, it has grown a lot. They've become a lot more flexible. I think one distinction that might be worth drawing is there's sort of higher education, post high school, and then there's K through 12, which has also now been added to the list of qualified expenses. Patricia, do you want to speak to that a little bit?
Sure, I definitely want to speak to that. So yes, in recent years, as Marissa said, the scope of 529 and permissible uses for withdrawals has grown. And one of the ways it's grown is to expand to K-12 tuition expenses in connection with enrollment or attendance at elementary or secondary, public, private, or religious schools. And I am reading this because I want to be precise. These are tuition only expenses in connection with enrollment or attendance at elementary or public, private, or religious schools, K through 12. So that's elementary or secondary. And that is up to $10,000 per year in aggregate per beneficiary, can be withdrawn from the 529 program to pay for those types of tuition expenses. I do want to mention a few things about this. While that is permissible at the federal level. That definition of qualified withdrawals has been expanded to cover K-12 tuition expenses. It may not be the case at the state level, meaning you should check with your 529 plan if you intend to pull money out for this purpose and make certain that it aligns with the state tax code for the state whose plan you're invested in, because it could, in some instances, be deemed a non-qualified withdrawal at the state level, even though it's permissible at the federal level. So just check on that. The other thing I want to say about this, and I think it's great that 529 plans are expanding in various ways, but I encourage people, if they're thinking of taking money out for K-12, think about the impact that will have on your college savings goals. Also think about what investment option you have your funds invested in. If you happen to have them invested in something where it was designed to have, an 18-year horizon or so many years until the child gets to college, and now you're pulling money out earlier, you will want to check on the investment design to make sure it's appropriate for whatever your goals now are with respect to those funds. If you've got a financial advisor, you could certainly talk to them about that. You could probably even call your 529 plan. They cannot, I assume, give you investment advice. They don't know you personally, but they can certainly guide you about the various investment options that may be more appropriate if you do intend to pull that money out prior to college.
Okay, and just to emphasize, I see Folka just asked, can I use a 529 plan to pay for private tutoring for my K through 12 kids or test prep? And that answer is no. As you just said, it's only tuition and only up to, I think it's $10,000 per beneficiary per year, right? Okay.
That K-12 is incredibly narrow. It's tuition only. And so what you have to remember is, they're not going to ask you, you're not going to have to show proof when you take the dollars out. It's in case you're audited, you'll have to have those receipts and to be able to prove it was only for tuition at the institution that's permitted. So again, like Patricia said, and she was spot on, where you're going to see the variances for K-12 is by state, and they are far and wide. So you're going to want to definitely look at the plan that you're looking at if K-12 is something that you're very interested in. A lot of these plans weren't designed for saving for K-12. It was that longer horizon for higher education. So make sure you do your due diligence and read those disclosure booklets carefully before investing.
Yeah. And one thing I'll just go back to then in terms of higher education, post high school, it's all of the tuition and fees, anything that's deemed by the college as a necessary expense, room and board as well. And that counts for college, graduate school, medical school, right? Any of those, because that question came up a few times.
Yeah, there's a great page of the cost of attendance. So most colleges, universities, community colleges, everyone will have a page that's cost of attendance. And that's going to have your room and board fees for the year or for the semester. You're going to have meal plans, all of that information. So you want to look for that cost of attendance. And it's a great habit of just printing that page for any time that you are making payments for school, or to even plan to get an idea of what's it going to cost if you know your student is a freshman and in high school and they know the school, they're already in love, they've visited the campus, they're ready to go. To have those pages either for planning or to kind of back up your planned expenses. But cost of attendance is what you're looking for.
Yeah. Quick administrative note for the attendees. We are getting a lot of questions coming, which is great, but I just noticed that some are coming into the chat box. If you look, you should see both a chat and Q&A in your panel. Please use the Q&A because that's what I'm looking to for the questions, and leave the chat for Mark to enter useful links. So you can find useful links in that one. So just a quick note for attendees. All right, so we have a lot of related questions that I'd like to cover before we get to our next topic. And let's start with, okay, here we go. This is a question that comes up all the time. So which 529 plan can I get? Can I get a plan from another state? And if I get a plan from another state, does my child have to go to school in that state?
So any individual can have any plan they'd like to have. So it's an open market. What you want to do is you want to find the plan that works best for you. You want to look at investment options. You want to look at, again, always check your home state's plan first to see if there's any special tax advantages. If there's someone that you're already investing in you can absolutely pick whichever plan you'd like. just as you can pick any plan that you'd like to have, any school that takes federal financial aid, so you do not have to go in school because you have a specific state's plan or in-state school, excuse me. Again, the litmus test is any school that accepts federal financial aid, you can use any 529 at. Anything you'd add to that, Patricia?
I would say that people sometimes don't realize they can have more than one 529 plan. So if your state offers a state tax deduction that you don't want to miss out on, you can invest in your state's plan up to a certain amount, and you can invest in an additional plan as well. Sometimes financial advisors have a wider array of options than you yourself would have considered. So perhaps you'll go in something that your trusted advisor recommends, and perhaps you'd also like to be in another plan as well. Marissa's plan has this FDIC insured option that I would say most plans do not have. So if you have a desire to have absolute certainty with respect to the security of your funds, because the funds are generally invested in the financial markets, if you wanted something like a CD, which Marissa's plan has, you could invest a certain amount in that and then put the remainder of your funds in another 529 plan. So I hope that adds a little bit more color to what your options are.
Right, absolutely. And I think on that note, maybe it's a good time, I'm sure more questions will still come up on some of the 529 basics, but maybe it's a good time to switch to types of 529 plans. Let's see, Marissa, can you start us out by explaining, we often talk about in the industry DirectSold and AdvisorSold plans. So can you talk about what each of those is?
Sure. So DirectSold, just like the name implies, it's direct to the consumer. You're generally going to open this account online, sometimes quick as 10 and 15 minutes. If you've got your social security number for the Benny and excuse me, the beneficiary and your mailing addresses and such, I mean, you can go right in. Generally, it's going to be through a website or, Ready Save 529 app now. While you can't open your accounts through there, you can go in and check and see balances and make additions and things. So you're finding more things now available in the direct market. So you would just go in, it's self-managed. So what you're going to find there, typically maybe a shorter list of investments. The idea is that this is for anyone who wants to save for higher education. And so it's meant to be user-friendly. You're going to be able to go in, pick potentially, either a year of enrollment or, age-based portfolio or individual portfolios just from a handful of choices. And then get started, as we mentioned earlier, with as little as $10 or $25 to start getting that investment growing for you. On the flip side of that, there's also the AdvisorSold plan. So this is where the industry actually started, where you'd work with a financial professional who talk to you about your goals. You're going to have that professional advice, and they're going to have access to a longer list of investments. And part of that is this is for someone who, again, you're going to be using professional. They have training and licenses, and they're more comfortable in that space. And so they're going to be able to help you build that portfolio from a larger variety to kind of get yourself set up. And generally, those are going to have maybe a few more costs involved, again, because you're paying for that professional advice, but also a wider range of investments. So again, direct is for someone who just wants to go in and do it for themselves. Tends to be a little bit fewer options, lower cost, where the AdvisorSold is going to be from the professional side of the business, and a professional is going to help you set that up. You actually generally need to work with someone in order to have access to those investments.
Right. So the advisor or broker dealer would have to actually open the account on your behalf.
Exactly.
And I think for the people who are interested in AdvisorSold, I guess another advantage is that if you're have a relationship with a financial advisor, they also have a view of your total financial picture and may help you with thinking through whether there are some other supplementary accounts or investments that you might want to do to the UGMA or something else, as well as your 529 plan.
Well, just like Patricia mentioned, you have lots of ways you can save. There's lots of vehicles. And this is someone who maybe can put the time and effort into it that you don't personally either have the time or effort or care to. You'd rather pay someone to figure this out for you. And they're wonderful for that. I mean, we have some of the best professionals in the industry. It's billions of dollars a year being invested by folks who know how to do it. And so that's a great option for someone who wants to know and have it professionally managed for them. If that's not something you're comfortable doing it for yourself. But again, I mean, the direct side of plans, they're incredibly popular. And states work very hard to make sure they're accessible to all residents.
Okay. And Patricia, within the DirectSold realm, we have 529 savings plans and prepaid tuition plans. Can you talk a little bit about what each of those are?
Sure. You said prepaid tuition plans, right?
Right.
Okay, yeah. And I just want to compliment what Marissa said. There is no one way to go in terms of saving in a 529 plan. Either approach is really fine depending on your preferences. And you can start with one approach. You can get an account open very easily on your own in one of the direct options. You can always, if you find you now have a financial advisor in your life, you can certainly switch to a plan that they also offer. So there's no one way to go, and don't feel stressed about it. What's important is that you get started. And financial advisors add tremendous value, but they're not necessary to get you up and running, and many people go it alone. So there's no preference here. In terms of prepaid tuition plans, which was your question, Martha, these are also 529 plans under Section 529 of the Internal Revenue Code. And what they allow is for account owners to pre-purchase future tuition at a predetermined cost today. Oftentimes they're purchased by the number of years or credits or units. Sometimes they're in a lump sum or in installment payments. But some parents and grandparents like the certainty of buying something now and knowing exactly what they're getting. What they're getting is an investment in something particular. Oftentimes it's within a particular state where you've got to use those pre-purchased credits within a certain state system of schools. There are currently, I believe, 10 prepaid tuition plans across the country. They're definitely worth checking out if you think that approach sounds good for you. And there's a private college 529 plan, which is a little bit different. It's not aligned with a particular state. It has several hundred private colleges that have agreed to offer this type of benefit, buying tomorrow's tuition at today's dollars. I would check into those sorts of things. If you think your child's going to go to one of these private colleges, you're quite certain of it. Maybe it's where you and your partner have gone and you're certain your kid's heading. That's worth checking into. And the states that have prepaid plans are worth checking into. I will mention they are typically prepaid tuition plans. They're not going to cover the full cost of attending higher education in many cases. So you may want to, as I said before, 529s complement other savings options very nicely. This is a perfect example. If you find yourself interested or attracted to a prepaid option, maybe you'll complement it by investing in a 529 college savings plan, which more broadly covers the full cost of attendance, as Marissa mentioned, at these post-secondary institutions. So I would say each of those prepaid plans, just like the 529 college savings plans, are unique. They're worth exploring if you think something like that would be of interest to you and you feel like you know well enough that your child would be inclined to go to an in-state institution or to one of those private colleges or whatever the criteria is for the different plans.
Right. Okay. That's great. All right. Let's see. We have so many questions coming in. But let's do this. Let's go on. Let me circle back to one thing. Marissa, when you were talking about setting up a DirectSold plan and how easy it is, and all you need is your social security numbers and your beneficiary social security numbers. I just wanted to, there's a couple things we didn't cover on beneficiaries that I wanted to come back to. So one is you can actually set up a 529 plan before your child is even born. So i.e. before they have a social security number, right? Can you talk about that?
Absolutely. So what we're finding now is a lot of families want to start as soon as possible, right? To start saving, because it's a long journey for folks. So what you can do is you just open the account, and the account owner can also be the beneficiary, which is pretty exciting. So whether you are planning for future children, for yourself to get back to school, maybe your partner, or, if you're someone who, you have, again, nieces and nephews or grandchildren, you can always open that account and then have yourself or, as the beneficiary. And then what happens is Once you want to change the beneficiary, and this is something I don't mean to, spoiler alert, but you can change who the dollars are used for. So when you open the account, you're the account owner, and then you name a beneficiary, whether it's yourself or someone else. So when we get this question a lot, like, what happens if my child doesn't go to school, or what if we don't need it, they get a full ride, whatever, like, what can I do with those dollars? So to change a beneficiary on an account, you're going to look at the original beneficiary that you started with. The IRS defines member of the family, and you can change that beneficiary to the member of the family. You can go out as far as first cousins, and steps count. So for example, I open the account, I name one of my nieces as a beneficiary. If that niece doesn't need the money, I look at her, and I can go out as far as a first cousin from her to rename for those funds and change that beneficiary. So hopefully I didn't explain that in too deep of a weeds way, but just knowing that you can change it to another member of the family. The IRS defines member of the family, and it is as far out as first cousins. You can also go back to yourself. It goes both directions. And so there's a lot of ways to use those dollars and to make sure that you're able to utilize those in a qualified way, so there's not additional taxes and fees and things.
Yeah, that's fantastic. So to summarize on that, basically, before a child is born, you can set yourself up as a beneficiary. And once your child is born, and once you've gotten the Social Security number, you can easily change the beneficiary. And similarly, if down the road, because this is a question, like you said, that does come up a lot. What if my child gets a scholarship? What if they don't go to college or an apprenticeship program, or any of the many, many things that you can pay for with a 529 plan? Well, you can just change the beneficiary to another child, another family member, or even change it back to yourself, right?
Exactly. So just the idea of how does a beneficiary work and what happens and how can I change that? That's kind of the crux of that. So there's always that flexibility. And again, like you said, if baby's not here yet and you want to start saving, you can absolutely put that in your own name, change it later. And the other thing to keep in mind, and I think Patricia hit on this earlier, is there's no time frame. And so, say you have her son's in college and he's about, when he's ready to graduate and there's still money left, you can leave that account open for future grandchildren. These are now becoming legacy accounts. From the 25th year of 529 plans. It's our 25th anniversary. And so now we're seeing folks have used these accounts and they want to keep them open for future generations.
Right. Yeah, absolutely.
Martha, can I add one more thing about the value of opening an account before the child arrives? Those of us who have been parents know there are those sleepless nights and complete exhaustion once the child arrives, and lots of things to do. Many balls in the air. So I would say getting an account open before the child arrives really gets one thing out of the way. The other great thing about getting that account open before the child arrives is that you can invite friends and family and your employer and your colleagues to contribute. Everybody wants to buy something, whether you're having a formal baby shower or not. Having that account opened opens the door to people being able to contribute and contribute early. So I think it's a great idea to the extent you can. You're a little less stressed, a little less busy before that little one arrives, get the account opened, then change the beneficiary. And I want to say one thing: when you change the beneficiary to your newborn child, you have their Social Security number, please make certain that your investment option aligns with the age of that new beneficiary. You may be 30 years old as the mom prior beneficiary. Now you've got an infant. So you want to make sure, just check your investment option to make sure you've got something that aligns well with a young child, because they've got many years ahead for that account value to grow.
Well, that is a perfect segue, Patricia, because next I did want to talk about investments and savings options in 529 plans, if we can just touch on this. So it has been mentioned, I think both of you have talked a little bit about age-based or enrollment date portfolios that are offered. So let's just start with, actually, Patricia, let's start here. Where it happens to your money in a 529 plan? Where does it go?
Okay, so depending on the 529 plan that you've decided to invest in, it's going to go into most likely a professionally managed investment portfolio. You may know that each of the states that have 529 plans, and that's every state except for Wyoming, has professional money management for the 529 programs and lots of safeguards in place for overseeing it. oftentimes the states hire a money management or mutual fund company to invest the funds on your behalf. There's a handful of states that manage the money themselves, but where your money's going is based on the plan you selected and the investment option that you selected within the plan. And I think Marissa's going to talk about a little bit about what those options tend to be.
Yeah, perfect. So let's start with age-based portfolios, Marissa, since that has come up a few times. And obviously what you choose to invest in is a personal decision, or you may have a professional advisor that helps you with that. However, we often on Saving for College do tell parents that age-based portfolios are an easy way to get started. So can you talk a little bit about what they are?
Absolutely. So age-based and year of enrollment have the same idea, is that your investments are based on the age of the beneficiary. So, and Patricia just hit on this. If you have a newborn or 2-year-old, you're going to save very differently when they're younger than when they're, say, 14 or 15 years old, right? And so that also leads into the question of, do I need to have one account for all of my kids or one for each? Well, I mean, time horizon really plays into that, and what your personal preference is. There's no wrong answer except not saving, right? And so, age-based or year of enrollment, those are going to be invested based on the age of the child. And I will tell you, these are wildly popular. I would even say between our direct and advisor plans, both heavily invest in these age-based options, because what happens is, you invest when the child is X age, and as they get closer to age of college or education or whatever they're going to do past high school, those investments become more conservative as they grow older. What's kind of cool about this is this automatically happens, right? So it's managed for you. You don't have to check it every 6 months and go in and change it. These portfolios are built to do that. And so as you're looking at plans, you can kind of click through the websites and kind of see like what the equity amounts are in each of these and all of that. But what you'll see the chart where when they're younger, what the percentages are. And then as they get older, it grows more conservative, more towards capital preservation, because what you don't want, and again, this isn't financial advice, but what you don't want is to be in a super risky market kind of situation when you need the money in a week. So it gets more conservative so that the dollars are there in a safer manner. And I am going to use air quotes. I think that's legitimate. They're for a more conservative manner when it comes time for them to use those dollars. But just keep in mind that that's automatically done for you. And it's not something you have to go in and change. Now, again, you want to make sure, if your appetite changes or you have multiple kids or your goals change, that you do revisit that. You don't want to set it, forget it. That's not really the right term, but just know that it's professionally managed for you and it's incredibly popular.
Yeah, and I just want to underscore a couple of things, because these are a couple of questions that came up. So unless you are opening a prepaid tuition plan, or we'll get to FDIC insured plans in a second, your money is going into an investment. So it is subject to what's happening in the marketplace. And it can go up or down. And so again, just kind of reiterating, that's the benefit of the age-based portfolios. Parents have to spend less time actively managing or thinking about it, because it is shifting for them into more conservative options. And so now, Marissa, could you talk about, are there low risk options out there, and what about FDIC insured options?
Absolutely. So just like what Patricia mentioned earlier, I mean, you can have a variety of things. And so one of the plans the plan that's sponsoring today's webinar, actually, it's the College Choice CD plan. It's FDIC insured, which for those who don't know, that means it can't lose value. So your principal comes in and you're going to get a rate of return. Now, full transparency, return rates are not great right now. It's just the economy and the way that it is. But what that also means is that the rate that you're going to get on those dollars, and it can't decrease. So if you're someone who you need to know where it's at, you're not going to sleep at night if there's any market movement, if that just freaks you out. Some folks like this as their whole savings. Some like it just as a portion. They may do an age-based portfolio for a percentage of their dollars, and there's some of their dollars are FDIC insured. Lower rate of return, but you do have those guaranteed dollars. And the other thing that's cool about using the FDIC insured option is, particularly in states like Indiana, and I believe even Pennsylvania gets parity. So it doesn't matter where you invest your dollars. that you get those state tax benefits on that. So in addition to it growing, tax-free and the withdrawals being tax deferred, whatever your state gives for a credit or deduction, you also get on those FDIC insured dollars. So there's lots of advantages if you're somebody who's market adverse to still kind of use this as a vehicle for yourself. So it's for sometimes our later savers, if you're going to need those dollars sooner and you don't have time for market recovery, or just someone who's like, I don't feel comfortable having it somewhere I don't understand, then a high yield savings account is something that's attached to what we offer in our CDs. And at least in our case, they're fee free. But otherwise they're going to be very low fee depending on which products that you choose.
Right. Yeah, thanks for explaining that. And, I will mention that in some of the age-based portfolios, some of the money will shift into similar savings products, some of which are FDIC insured, some of which aren't, but either fixed income products or just bank savings accounts. Okay, so sorry, Patricia, I thought you had something to add, but I don't think you do. All right, so now we get to some of the questions that, again, came up in the registration, and I've seen come up again today. It's related to two themes. One is about savings goals, and the other is it too late? Because my kid is a freshman, a senior, or even if they're still in college, can I keep contributing? So let's start with Patricia, if you could walk us through a little bit, how should parents and grandparents think about how much to save for college and how much they should be saving per month?
Sure. First of all, I want people to know that whatever they can save is that much less that their child will have to borrow and repay with interest. So we've got a lot of guilt as parents along the way. We've got a lot of balls in the air. Do the best you can, but know that whatever you do is going to help your child. So I don't know that you need to get caught up so much on the exact dollar amount, but please get started and do what you can. And we can talk about other ways that others can help. But in terms of how much you should save or how to think about this, you really need to think about what your goal is for your child. And I know that may change as the child matures and you know more about their interests and talents and where they might be heading. But you need to think about what type of education are you saving for? Is it a 4-year public in-state university? Are you thinking you'd want your child to pursue a trade or technical degree? Is it something that involves graduate school? I mean, you sort of have to have an idea of what your vision is for your child to at least be able to assess what that may cost when your child is graduating from high school and about to pursue that form of education. So there's not a clear answer here. You also want to think about not only the form of education that you're hoping they aspire to, but how much of the cost you want to cover. You know, few families wind up covering 100% of it. Do you think you'd like to cover a third of it, or is it a half? Are you hoping that others contribute as well? That's great. You may want to know who else in your family is dedicated to helping you with this, because if they're saving too, that might affect what you're saving. Another factor is how many years is it until your beneficiary is going to reach college? That's going to impact how much you save. And along the lines of what Marissa discussed, the type of investment option that you're most comfortable with is also going to have an impact. The more fully insured options will have you sleeping well at night, but the ones that are riskier might help you to reach your goals a little faster. Maybe you don't quite have the peace of mind, but you want to try to reach a higher goal. So you've got to keep all those factors in mind. Savingforcollege.com, I am certain, has calculators that you can use, and there's other ones available across the internet. Get a sense for when your child's going to be going, what type of school you think it is, even if it's a broad range, you know for sure it's going to be a private college, or you know for sure it's going to be a 4-year public. And get a sense of what that is, and then consider how much you want to save and back into what it will take to get you there. But do what you can and get started is really my advice.
Yeah, and Patricia, like we often tell parents too, don't feel like you have to try to save for 100%, or if you can't save for 100%, that it's not worth saving, right? So, I don't think it came up today, but parents may be aware of the of college sticker prices versus net prices. So sticker prices are real and they're scary, but in reality, most people are going to pay something less than that. You know, and even to your point, if they can just save 10%, 25%, something, it's something that will help their child, right?
Yeah, that's right. Anything will help. And I'm telling you, I've just gotten my own son through college debt free, largely due to the 529, also due to some good decisions along the way and him getting some academic scholarships, etc. But I got to tell you, it feels great to have contributed what we did. And it felt great to teach him along the way that we were saving on his behalf. There was a tremendous amount that he learned through that process. And I don't want parents to fail to recognize there's a lot of learning here and a greater appreciation for the education when the child knows how you got him or her there.
Congratulations, by the way. It's always good to hear success stories. Hopefully that inspires the audience. So Marissa, what about this question of, is it too late? And how long can they keep contributing?
Love the question. It is never too late. Okay. Like Patricia said, anything that's saved, or the idea of saving anything, one, you're going to have a conversation with the student, and if that's yourself, right, you're worth investing in. So it's never too late to start saving. The other thing to keep in mind, and I have found this like anecdotally when I'm talking to folks, is like, oh, well, you know, he's going to start school in 2025. I've only got, you know, 4 years. Well, no, I mean, you can continue to contribute through the entire time, right? You can contribute through senior year. So instead of having what you think is 4 years, you have 8 years, or if they're in a 6-year master's or PhD program, like a lot of our pharmacists are, you can absolutely save and use those dollars in real time. Check the state plan that you're looking at. Make sure if they've got any, you know, time frame requirements or things like that. I can speak for Indiana where we don't, that you can use those dollars in real time. So what you're able to do is take advantage of those tax credits or deductions that the state offers, that tax-free growth, which you're generally going to get more over the longer horizon. But just the idea of when you are used to saving on a regular basis, if you're having those dollars taken out of your paycheck automatically, continue doing that while they're in school. Those dollars do add up. Maybe $50 a paycheck doesn't seem like a lot, but over 18 years or 22 years, when you think about saving during their time still in school, that's going to be great for you. And then the other thing to think about is, and I always forget that your son just graduated, Patricia, I keep making him younger. When they're done, if there's money left, again, you can keep those accounts open. If you can afford to continue to contribute, that's great. If not, you can let those dollars ride to continue to grow in the market until there is another person that you can use those dollars for, because you don't have to change the beneficiary. There's no time frame. It's not, you don't age out, you don't income out. You can absolutely keep those accounts open with those dollars. So really, there's no time limit.
Yeah, absolutely. So there's more that we can talk about on this topic. However, since we're running short on time, I did want to see if we could briefly touch on our last two topics. So the first is about how 529 plans affect financial aid. So Patricia, and again, you know, there's a lot of, I'll just say there's a lot of information on this. We could do a whole webinar just on financial aid. So we're just going to touch on it to, so people understand the basics. So Patricia, can you explain, will savings in a 529 affect financial aid and how?
Sure, I'm happy to touch on that. And indeed, you know, any savings do impact financial aid, but savings in a 529 plan in particular for federal financial aid purposes have a very insignificant impact. Parents need to recognize that it's really not parental assets such as the 529 college savings that affects the financial aid package. It's often more the annual income of the parents that does. But for 529 purposes, up to 5.64%, so only up to 5.64% of the 529 account value in a parent-owned 529 plan will count toward the federal financial aid evaluation formula. So if you've got $10,000 in a 529 plan account, $564, up to $564 of it will count. That is really not very significant. It is much better to save than not to save. Now, certainly states as well as institutions themselves look at assets and income in different ways. There could be an impact at the state level or at the institution, but largely for the federal financial aid treatment, it is very minimal. And what I also want to remind people is what is financial aid? It's largely comprised of student loans and work study. It is not necessarily, and often not at all, free money, grants and scholarships. So keep in mind that there's a small impact at the federal level. There may be an impact at the state and institutional level, but it is still better to save for college, in my view, than to not have prepared for it.
Right. That's, I think you explained that really well. And basically, like, it's just, don't let it be an excuse. Better to save and be prepared. So I think that's the advice. And let's talk about grandparents and 529 plans briefly in the 5 minutes we have left. So, Patricia, we'll stick with you. How can grandparents help their grandchild with college costs?
Right. So as Marissa mentioned earlier, it takes a village to get a child to and through higher education, and grandparents can play really a very valuable role. Their support can be tremendously helpful, not only to those grandchildren, but to their adult children who are the parents of the grandchildren, because they're struggling to save for those grandchildren. So a grandparent can open their own 529 college savings plan if they're so inclined. And as Marissa said, they can take advantage of the state tax deductions or credits as an account owner. And in some states, even if they're not the owner of the 529 plan, they may be able to take advantage of contributing. So they can open their own plan if they choose to do so. They can also contribute to a 529 plan owned by someone else, like their adult child. Those are terrific ways that grandparents can help. Beyond 529 plans, there are things that they can do. They can pay tuition directly to the college. There's lots of ways to help. But with respect to 529 plans, the most common ways grandparents help is to open their own account for a grandchild that they love, or contribute to an account that someone else owns for that particular grandchild.
And again, here, people are asking, or I think through Bui asks, when I open a 529 plan under my name and use it for college fund of all grandchildren, or do I have to indicate which one? So first of all, you'd have to indicate one beneficiary. However, to the point we made earlier, he may want to consider opening separate 529 plans for each of his grandchildren. Is that right, Patricia?
I think so. I think based on the age of the beneficiary, as Marissa said earlier, it's important to have their own account. And I also think psychologically, if you let the grandchild know that you're saving for their future, it's kind of nice to show them from time to time in age appropriate ways an account statement with their name on it. I think that's tremendously impactful. So I would suggest, listen, any saving is great, but if you can have accounts earmarked for each grandchild, even better. It keeps it separate and apart. They all have their own goals and aspirations, and why not separate them out and show each of them if you're comfortable that you're saving for their future.
Yeah, absolutely. And Marissa, I think it was briefly mentioned earlier, but if grandparents or other family members or even friends want to help out, can you talk a little bit about gifting, ways that people who are not the account owner can contribute?
Absolutely. I'm a huge fan of this, as I know Patricia is as well. Most plans have a connection to some sort of gifting platform. UGift is a tremendous way that friends and family can go on. They can register and then contribute to accounts. They can set up recurring contributions. A little guilt here to aunts and uncles on the call. You got to be doing your part to get these kids ready for school. Buy them the fun stuff, get them the Lego bricks that the parents can step on, or the drum kits. but make sure that you're also contributing to their 529. So you can do, again, through online gifting platforms, you can sometimes mail contributions directly to the plan. Just have a chat with the account owner about kind of what methods work. And again, if you're in a state that has a tax benefit, take a look at that. So there's a lot of online ways, and there's also a unique product out there that I'm a big fan of, Gift to College, where Patricia is the COO. You go back, and I'm gonna tell you what, there's something about getting actual mail and getting a gift card. And Gift to College offers these gift cards in local retailers. So if grandma or aunt and uncle want to go in and just grab this gift card, they can also buy them online, but there's something about sending that kid a card on a holiday that's got some money in there for school. So, and that can just be redeemed right into their 529 plan. So there's really, depending on how you personally like to shop and what you like to provide, there's a partner out there for you to be able to contribute to a 529.
All right, we are almost out of time. So a few things I want to do before we wrap up. One is I just saw a comment come in from someone in the audience, Jimmy Lima, and I just wanted to share it with everyone. He says, I have twin daughters and they are now seniors in high school. I can tell you from experience that I wish I would have started their 529 plan much earlier than I did. I started in middle school. If you're middle class and know you want to get help from the government, and know you won't get help from the government, start a 529 plan now. Do not wait. Start investing small and increase deposits the closer your child goes to college. So I don't think any of us could have said it better ourselves. All right, so let me see now if I can just, here we go, flip ahead to the next slide. So basically a couple things. First of all, we want to thank everyone. I know we ran out of time. There were so many questions we didn't get to. I'm so sorry. For the audience, you can try going to forum.savingforcollege.com. We have a forum there. You can try asking questions in there. Thank you all for participating, for being so active and asking so many wonderful questions. Marissa and Patricia, thank you for sharing all of your expertise and advice and information with the audience. I think it was fabulous. And I want to announce the two winners of the $500 College Choice CD drawing. They are Rachel Lamb and Roshan Kushalani. So we will be contacting you. Yay! We will be contacting you afterwards to get that set up. So thank you. And you can learn more about College Choice CD at collegechoicecd.com. Get more information at savingforcollege.com. We'll be sending out, as I said, the email with a link to the recording. We'll include some of the links that were shared today as well in there. And that's it. Thank you, everyone.
Mm-hmm.